At Stress Less Financial, we protect your retirement in style. What does style mean? That's what we're going to be talking about in today's video. Well, first off, style stands for something, and we're going to break that down today. It's actually a great acronym. There are multiple different vehicles that we actually use to protect your assets in style. Some of these vehicles are flexible premium annuities, MYGAs, also known as multi-year guaranteed annuities, income generating annuities, as well as fixed indexed annuities. Fixed index annuities also have a couple other names, also known as single premium indexed annuities or even deferred income annuities. The common denominator in all of these vehicles is that the worst case scenario in any year is a 0%. You go with a MYGA, you have a fixed rate on there. However, any of these other vehicles, the floor is 0. The market goes negative, you would just get a 0% return that year. So you're protected from any type of stock market loss. So let's break down this word style together. First and foremost, the S stands for safety, the floor of 0. So the market goes up, you get a chance to partake in the gains. You have $100,000 turn into $110,000. You're locked in at 110, and now 110 is the new floor. 110 turns to 130, 130 is the new floor. So you're locking in your gains along the way. You got that safety net there to catch you when you fall. The T in style stands for taxes. We're going to help you defer all taxation along the way. The only way you're going to trigger any type of taxation is if you withdraw money from your annuity prematurely, or if you've hit 73 years young and you're having to collect your RMDs, also known as your required minimum distributions. But we're going to help you defer all taxation. With MYGAs, it's going to defer taxation as well. Unlike your CDs at the bank, you're going to pay an income tax upon the gains each year, which is okay if you want to pay tax on your money on an annual basis. However, if you'd like to defer all taxation, talk to your broker about a MYGA or any other type of annuity vehicle. The Y in style stands for yield. You still get an opportunity to partake in any type of market gains, all the while protecting yourself from the losses. There are 3 ways to make gains in an annuity. Now, there's your caps, your spreads, and your participation rates. Now, a cap is the ceiling on how high of a return you can get. So if your cap is 10%, for example, and the market goes up 5%, well, you can get 5% on there. The market goes up 10%, you get 10%. However, if the market gets 20% and your cap's at 10, you're going to stop there at 10, but the floor is still 0. So in this case, with your cap, you could get somewhere between a 0 and a 10% return. The next is a spread. A spread is going to be the gap between the actual return of the market versus what they're going to give you. So if the spread is 5% and the market gets a 20% return, you're going to get 15 of it. The market gets 10, you'll get 5. If the market got 5, though, in that example, you would get 0. However, if the market went negative, you would just get a 0% return. You still have a floor in there, even with a spread strategy. One of the most popular strategies that I've seen people go with in annuities is the participation rate. A participation rate is the amount of participation that you'll get in any index that you're in there. For example, you index the S&P 500, and there's an 80% participation rate in there. What that means is if the market gets 10%, you're going to get an 8% credit to your account. If the market got 20%, you would get a 16% credit to your account. However, if the market did 0% or negative, you just wouldn't make a gain that year. So those are the 3 ways that we're able to make a positive yield in our annuities, with caps, spreads, and participation rates. However, if you go with a MYGA, you don't have to worry about any of those other strategies. because you're simply getting a guarantee for a duration of time. The L in STYLE stands for liquidity. Now, liquidity is very important, and it's also very important that you understand the dynamics of different annuity carriers and how you're able to access your money. Many annuity carriers will give you a 5 or a 10% free withdrawal on an annual basis. Now, annuities do have surrender charges if you surrender prematurely, or if you needed to take out more money than the amount was allotted, there may be a fee on there. So make sure that you're not over applying for annuity and you're not tying up more than you actually need in there. That way, you still have the amount of liquidity that you actually need. Some companies will give you the 5%, and they may have some additional bells and whistles in there, while other companies will let you take out 10% on an annual basis with no penalties. Last but not least, we're going to cover the E in STYLE. E stands for estate planning, which is one of the most important things to consider when getting an annuity. Now, an annuity is a tax-sheltered asset over your money. It avoids probate when you pass away. If you have a great trust in place, congratulations on taking that step for additional protection for your family. If you don't have a trust in place, well, at least for the portion of your funds that are in an annuity, it's going to tax shelter your assets and help you avoid probate, unlike your conventional IRAs, 401ks, or other retirement vehicles, and even checkings and savings. So make sure you consider that when you're looking to protect your estate, if an annuity is the right fit for you. It will help with that. That covers STYLE and how annuities work in a nutshell, and to help you understand if it's the right move for you in the first place. We at Stress Less Financial work with many companies across America. If you have any questions, you can book a call with us using the link down below. If you like what you saw today, press that subscribe button, comment down below, hit the like button on there, and don't forget to subscribe to our ongoing newsletter.